Hi everyone, good day. I'm Loto Rules and this presentation is powered by Beable FX. Today we will be discussing the profit gap in Forex. Our objectives for today is to discuss the aim of trading, the classes of traders, the types of traders, understanding the dynamic nature of price movement, the difference between a consistent trader and a regular trader, the profit gap, and how to become a consistent trader. Then we'll go further by breaking the 3 stages of becoming a consistent trader, the step-by-step process of integrating consistency into your trading process, and the regular pitfalls in Forex. So the aim of trading, as we all know it, is to create additional income. But beyond that, the aim is to create a stable means of income. For example, if you're working in a bank or you're working in a manufacturing company or you're working in a fintech, the reason why you're working there is because aside from the knowledge and the experience you're going to get, there is an opportunity to get income, which is stable and steady. Being stable and steady gives you an opportunity to rely on something or to look towards something in expectation. Now, we trade Forex not because we just want to make money today or make money now. It's not a case where we want to put $10,000 today and withdraw $100,000 tomorrow. It's a case where most people who trade Forex or everyone who trades Forex is looking at trading Forex to withdraw money at regular intervals, maybe month end, maybe biannually, maybe weekly, maybe quarterly, just a means to know that, okay, every time you're trading, at the end of a period, you're expected to make some form of withdrawals to meet some expected needs. So we want to make trading stable, not just a scratch and win. We don't trade Forex because we're trying to gamble. We don't trade Forex because we're trying to win the lottery. You understand? So when we look at our aim for trading Forex, we have two key components. One, consistency. Two, profitability. One, consistency in the sense that it has to be stable over a period of time. Two, profitability in the sense that we need to make some returns on our investments. Now, in reality, we need to understand something, that consistency in Forex is more important than profitability. Because if you're going to attract investors or you want to talk to family and friends to come and invest in you, they want to see your track record over a period of time. And what everybody will be looking out for is not really how much you can make, but how consistent you have been over a period of time. We have 3 classes of traders. First, we have the losing traders. These are the traders who really don't know so much about Forex, but they've heard about Forex from motivational speakers and they've gotten so hyped. Then they put some income into it, and immediately they put their income, they almost start making losses immediately. This pullback here represents some period when they make profit, but ultimately their losses are usually bigger than the profits they make. And at the end of the day, they most likely bail out or lose everything in the market. There's a regular saying in Forex that 90% of traders lose 90% of their capital within the first 90 days of trading. What this simply means is when a trader comes in, he's most likely going to lose almost all of his capital within the first 3 months. And that is because consistency is absent. Now, we also have the struggling traders. The struggling traders are traders who have a bit of knowledge on Forex. Maybe they have technical analysis. They have a method of determining how the market is going to move, or they have someone that is giving them trading signals, so they trade the signal, but they really don't understand Forex in totality in terms of the psychological and risk management approach. So They make profits, then they make more losses, then they make more profit, then they make greater losses, then they make more profit and they make more losses. In McDougall's book and his teachings, he called traders like this boom and bust traders. Then finally, we have the winning traders. The winning traders are people who understand themselves, understand their trading methods, and they are able to apply themselves to their trading method in such a way that they know what they want from the market. Okay, so this kind of people, you see them, they make profit gradually, not steep profit like the struggling traders. So they gradually make profit, and when they make losses, they make sure their losses are short while they make their profit run. So they also make losses as well. But the difference between winning traders and losing traders is, for losing traders, the losses are bigger in terms of value than the profits, while for winning traders, the profits are bigger in terms of value than the losses. All right. I kept some footnotes below so that we'll just, to pick our brains. Now, here I wrote, the only skill needed to place a successful trade is the click of a mouse button, either to buy or sell a currency pair. I'll read it again. The only skill needed to place a successful trade is the click of a mouse button, either to buy or sell a currency pair. What does this mean? It means that for you to make money from trading, like today now, anybody who woke up this morning and just felt, oh, I just feel like buying gold. Clicked on gold today. Early this morning when the market opened, gold was at 17335. And a few hours later, it's currently at 1742. That's about 80 pips. So to get a profitable trade doesn't really take anything. To execute, it doesn't take anything. The only skill you need is to click a mouse button. However, to be consistent, there are a lot of psychological skills that you need to get. We want to talk about the type of traders here, and we have two major types of traders. We have the dynamic traders and we have the passive traders. The dynamic traders are traders who have the mental capacity and financial capacity to directly influence the market single-handedly. All right. So these traders are people who have a lot of resources, a lot of money. They have the technological advantage and manpower, and they tend to set up markets for themselves. So sometimes, in order to set the market right, they will buy when they want to sell lower, and they will sell when they want to buy. Okay? These kind of traders depend on their wealth and highly sourced information on what other dynamic traders like themselves are doing. These are the kind of people who pay Bloomberg or who pay some companies to do research and give them feedback on what the market is doing. So they have the information. They use information like the entire market outlook to know what all the retail traders are doing and what their fellow dynamic traders are doing. Okay? They need the resources of the passive traders who they can easily manipulate to make profit from the market. I'm sure we've heard terms like liquidity gap, SL hunt, and the likes. These are the traders that are capable of making such moves, and they do so to build wealth. So if they want to buy, for example, now a dynamic trader wants to sell the market. Let me look for a market. Let's say gold, for example. Currently, gold is at 1742, and the dynamic trader has done the market outlook and is looking like the maximum anybody is going to buy gold for is 1750. What they will be doing will be buying gold from 1742, which is the current market price, towards 1750. So as they're buying, a lot of retail traders will get on board and be buying along with them. But once they get to their limit, they sell immediately and remove their buy, and then the market drops and they make profit off the buyers. Okay? These dynamic traders are central bank, hedge funds, stockbroking firms on Walmart, Wall Street, and the likes. We also term them as market makers. All right. Now we move on to the other side where we have the passive traders. These are traders who do not have the mental capacity nor financial capacity to move the market. However, they have a trading edge to grasp the collective market, what the collective market is thinking, and they use that edge to their benefit. Who are these kind of traders? These kind of traders are traders like you and I, who do not know what other traders are doing, but we tend to have a mathematical set of calculations like Fibonacci, Elliott wave, or an understanding of patterns in the market. So we use all those patterns, repetitive patterns, to identify where the market may buy or sell. And we use that as an opportunity to make money from the market, okay? They don't have the capability to set up the market for themselves. So they focus on their own trading methodology, their risk management skills, and their own mental capacity to remain profitable in the market. What am I saying here? So a passive trader does not have control over the market. However, he has control over his resources. He has control over whether he buys or sells a trade. He has control over how much he's willing to risk. He has control over how much profit he wants to make from the market. Okay, so they control those things, and they use those things they can control to make income from the market. All right. Passive traders are dependent on their technical analysis and fundamental information in developing an edge to trade the market. So unlike dynamic traders who use market outlook and their wealth and say, okay, you know what? I give you an example, like Warren Buffett. Warren Buffett is a big name in trading, and I can also group him as a dynamic trader. We've had instances where we've heard that Warren Buffett made losses, yet he's still one of the richest men alive. How is that possible? Now, he may be making losses because he's trying to set the market for himself, but his profits will never be announced because his profit will usually be more than his losses. Okay, so passive traders do not have that capability of setting up the market. So they depend on technical and fundamental analysis to develop an edge, which will tell them where to buy, sell, take stop loss, or profit from the market. Okay. Passive traders also need dynamic traders, like dynamic traders also need passive traders. Now, passive traders need dynamic traders to create liquidity in the market. And this liquidity is what generates profit for the passive traders, okay? So if there is no liquidity in the market, passive traders cannot make any profit. This is the reason why the market closes on Friday. This is the reason why brokers close market on Fridays and open on Sunday. This simple reason is because most stock exchange where the dynamic traders are not available during that period to trade. So during that period, if you try to trade, you only have high spread with no liquidity, which is an absolute waste of time. Okay? Now, the passive traders include you and I and every other Forex trader you know. We are also termed retail traders. Please pay attention to the footnote here. There's almost no reason you could think of that would make your thoughts about the market true, whether the market moves in your favor or not. What does this mean? So as a retail trader, if you do your analysis and you say, okay, the market is meant to reject at 68.1 fib level to 161.8 fib level, and the market moves precisely the way you have mentioned it, please get this into your head. The market did not move because you said it was going to get rejected at 61.8 level, and the market did not stop because you said it was going to get at 161.8 fib level. The market simply moved because there were dynamic traders and a collective group of people who made the market move. Okay? Don't ever think that the market moves because you said so. Each time you think like that, you assume that you understand the market, and with your thoughts, you're able to move the market. Forex market is a $5 trillion market every day, $5 trillion transaction daily, $5 trillion daily transaction market. And we have over 1 million traders in the market. If we take your thoughts divided by 1 million traders, is highly insignificant. So your thoughts on the reason why the market moves is highly insignificant. So most of the time I hear traders say, why did the market do this? Why did the market do that? That's an absolute waste of brain power, emotions, which would further lead to further losses in future. Because when you assume you know the reason why the market is moving, and another time something happens, based on your assumption, you tend to form a pattern. And based on that pattern, you'll probably lose more money because the market may be moving for something entirely different. Understanding the nature of price movement. One, everyone in Forex market is present to make money, both the dynamic and passive traders. Dynamic traders need to make money to make more money to remain dynamic, while passive traders need to make more money to earn income and develop a lifestyle. Everybody is in to make periodic income from the market. For a currency pair to move from 1.000 to 1.010, it means that all the buy orders between 1.001 to 1.009 has been filled up, and vice versa. I gave you an example today. Gold moved from 1735 to 1742. For gold to move up from 1735 to 1742 means that 1736 to 1741, all the buy orders within those periods have been filled up. Okay, so the market basically moves based on the imbalance between the buyers and the sellers of that particular currency. Okay, that's the reason why a lot of people focus on supply and demand. When the balance is not, when supply is not equal to balance, you see a movement towards the parts where there is an imbalance. All right, a dynamic trader who is emotionally or financially capable has to make the move by buying or selling a currency to make that currency pair move. What does this mean? Remember, we said a dynamic trader is a trader who has the financial and emotional capacity to single-handedly move the market. Now, if the dynamic trader has reviewed his thoughts and his expectation, and he says that, okay, the only way I'm going to make money today is to move this market from point A to point B. Am I capable of doing so? Yes, they will move the market from point A to point B. That is when the market can move. If all the dynamic trader says, I'm not interested, the market is going to be static. That's the reason why some pairs can do 20 pips for a whole week, while some pairs can do 500 pips, 1,000 pips in 3 days, because it depends on the number of dynamic traders that are there to make the market move. While a massive collection of passive traders can also buy or sell a currency to make that currency move. If we have 1 million traders in the market and 9.9 million traders are buying a pair, it is bound that that pair is going to move. Okay, so it is not about the analysis, it is not about any holy grail, it is not about indicators, it is not about patterns, it is basically about someone's interest, either a collective interest of passive traders or a single interest of a dynamic trader to move the market. As I said earlier, the market moves when there's an imbalance between buyers and sellers of a particular currency. Finally, to buy or sell a currency pair, your conviction that someone somewhere will buy or sell at a higher or less lower price, respectively, must be beyond doubt. What does this mean? If you check the market outlook and you find out that, I'll also use gold. Since I've been using gold, I'll probably use gold as an example throughout this session. If they tell you that in the whole wide world, all the traders are not all the traders are not buying gold beyond 1750, which means that from 1750, all the buyers of gold will be out, then sellers would come in to sell gold. And you can say it for a fact. Maybe one mainframe somewhere that hacks into everyone's MT4 and other C trader and other trading platforms used. And it shows you that the general outlook is gold is going to sell from 1750. I can bet you that you're going to sell gold and not buy gold, because everybody is going to do what is logically reasonable. You understand? So you need to have the conviction beyond doubt that if I buy or sell a currency pair at a particular price, someone is going to buy at a worse price than I did. If the person buys at a worse price, it means that you're going to make money from the market. Okay? Now, the footnote below, I said, people who discuss fundamental news and use the same to explain why the market moves are subjectively speaking on what is reasonable, and they are paid to do so. There's no way to verify this information. So a lot of us go to investing.com, forex.com, forexreview.com. We go to different platforms to read what different people say. So some people will say because Trump tweeted this, that the market moved that way. But the truth there is you can't verify it because you can't see what is happening on the back end. So it's all just speculation. You understand? There are some people who would look at what Trump said, think about it, how it's going to affect the market, especially dynamic traders. They think about what Trump said, how it's going to affect the market. Then they use that to make their decision whether to buy or sell a pair, which may be the reason why the market moved. So it's not really about what Trump said, but about someone who sat down and decided to take a decision on the market, especially those that are capable of doing so, which we also know as the dynamic traders. Okay. Here we're going to talk about the difference between a consistent and a regular trader. One, the consistent trader trades without fear. The consistent trader trades without fear, while regular traders are strongly influenced by fear, and these fears usually lead to costly experiences or costly errors. Consistent traders understand that there's nothing emotional about the market, and there's really nothing their mental, emotional mood or their feelings can do about the market, because the market is simply balancing out the imbalance between suppliers and demanders, or demand and supply. So what they do is they do the analysis based on their edge. Once they have their entry and their exit point, they set their trades and they move on to the next one. If it hits SL, they already know their SL and they've already accepted their SL. If it hits their take profit, fantastic and great. Consistent traders always plan their trades. When there's no trade, when there's no plan, there's no trade. Consistent traders don't trade on impulse. They don't trade on feelings. Yes, you may place some trades based on what you feel and may be profitable, but you can never be consistent trading on feelings. There needs to be a rigid checklist, a specific checklist, a black and white checklist that is this present? Yes. 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 Based on the fact that these 6 things are present, I am going to buy or sell a particular pair to a point. And if I'm wrong, I'm going to get out of this trade at this point. So they always plan their trades, and not even just planning their trades. They don't just plan their trades. They plan what they're going to do while the trade is active. For example, if my stop loss is at 30 pips and the trade has moved 50 pips in profit for me, I would move my stop loss to my entry. If it moves 100 pips, I'll take partial profit and allow it to run. When it gets to my TP point, I will trail my profit, So they think ahead and they plan everything. They make a detailed plan. When they make a detailed plan, this takes me to the third point. They execute their plan. They do not deviate from their plan. They do not execute their trades without error. What does this mean? It does not mean that they won't have losing trades, What it simply means is when they take their trades, they trade in line with what they've planned. They don't go out of their plan. Okay, you could go in line with your plan and make losses, but it's better than not going in line with your plan, then you make losses, because you most likely make more errors and more losses. Okay. Consistent traders are not emotionally attached to any trade. So when their criteria are met, they take the trade, and immediately the trade is invalidated, they get out of the trade. They don't hope, they don't pray, they don't think, they don't feel that maybe the trade will come back in their favor. Once it's invalidated, they get out of the trade. While doing this initially, I made an example that, for example, you had a bullish reversal. Now, by the time London market opens, there was a deep bearish engulfing bar. It has already invalidated the bullish reversal. A consistent trader will cut his losses short and walk away and move on to the next trade, while a regular trader will be hoping that the engulfing bar will be invalidated back to the bullish reversal. And most times it does not happen that way. The outcome of trades. Consistent traders have not focused on the outcome of their trades in terms of the profits from the trade. Rather, they are focused on perfecting their planning and executing process for their trades. What does this mean? As a consistent trader, they work towards ensuring that they plan their trades properly, they execute it perfectly, and this would be their focus. Whatever the outcome will be, they are not really concerned about it. The only time they'll be concerned is at the point of doing a review. And their reviews usually come after a series of trade, not after not on trade by trade basis. Okay. Yes. So this footnote says there is no relationship with the market and your mathematical calculation, which is your trading edge. So the market has no hold, does not even recognize your mathematical calculation. The market simply does what the market will do. And you as a trader are supposed to do what you as a trader will do, okay? Or what you can do, not focusing on what the market is doing or what the market is not doing. The profit gap. The profit gap simply means your potential profit minus your bottom result. Have you ever sat down and you've done some analysis, and based on your analysis, you're looking at it that, oh, by the time I'm done this week, I should have made $50, $100, $200. Whereas by the time you're done, you're probably in a loss of $100. Well, that's what we term the profit gap. Your profit potential refers to the amount of profit your trading system can generate for you if you follow it efficiently. A good profit potential would usually give you a trading system that would give you a risk reward ratio of a minimum of 1 to 1.5 and higher. There are a lot that do 1.1 to 2, 1 to 2.5, 1 to 3, 1 to 5, 1 to 10, and a win loss ratio, a minimum of 60% above and above. Some people do as much as 90, 85, 90% winning ratio. Okay. And this will be tested on a series of trade, at least 20 trades. Okay. Now, your bottom line result is the actual statement, is your actual trading statement after trading for a specific period. So when you finish trading, you can review what you were expecting from the market and what your result actually gave you. Okay. Now, for you to close this profit gap, it involves you sticking and executing your trade more than you searching for a better trading system. Because if you have the profit potential in a trading system as mentioned above, you should make equal to that amount or more than that if you stick with your trading plan. When we're able to make our bottom line results equal to our trading system potential, then we can confidently say that our profit gap has been closed. Okay. Forex traders at best make educated guess. We make probable speculations. We don't know what the market is going to do. We can't tell what the market is capable of doing. However, we can tell what we're going to do in the market. And if we're going to do anything, the best thing we can do for ourselves is to stick to our trading plan. If we stick to our trading plan, we will be more profitable than we can imagine. How to become a consistent trader. Here I'm discussing steps on how to become a consistent trader. And if we're able to apply these steps to our trading system or our trading pattern or our trading life, I'm expecting that we would see some form of progress. And by the time we perfect it, we should have attained something close to being consistent in our trading. The first thing you need to do is to review your trading method or your process of doing analysis and ensuring that it is detailed. Okay, it must be detailed in the sense that it must be able to identify your entry and exit points and should meet the minimum criteria of at least 1 to 1.5 risk reward ratio and over 60% winning rates. Okay, then you must have a process of utilizing the information provided by your trading method. The way of utilizing is to identify your risk parameters, which involves the amount of exposure you're going to accept. It involves the money management strategy, which involves where your profit will be and where your losses will be, how you're going to take partial profit, how you're going to lock at entry, how you're going to throw profit and the likes, how many entries are you going to take and things like that. Then it also involves your profit objective. What is your expected profit point? Are you going to use a static profit of saying maybe every trade should give me at least 100 pips, or you would use your analysis and say, okay, this trade should be able to give me 400 pips, but I'll take profit at 100, 200, and 400. So you would decide that, okay? Then you also need to be comfortable with the execution of the trade, okay? When we're talking about being comfortable here, we're talking about you being okay with the outcomes. Before you take the trade, know and understand how much you may lose from that trade and be comfortable with it. And the profit is not really a big deal, but the focus is on the losses. If you know how much you may lose and you are willing to accept that loss, then you will be able to execute those trades with ease. Number 4, avoid self-sabotaging beliefs. Now, self-sabotaging beliefs are beliefs within you that may be coming up due to past experiences or wrong information you've gotten from other traders in the market. It is because of this reason a lot of people have trading mantras, okay? So you need to tell yourself that you're a successful trader, you're a fantastic trader, you know what you're doing in the market, you would follow your trading plan, you will stick to your trading plan. You need to form a mantra. So whenever you're having self-sabotaging beliefs, you say your mantra to yourself to negate all those thoughts, because there are some people that if you give them $100, they can raise that $100 to $1,000 every day. But once they try to go above $1,000, they lose the whole account. It's because they have a mindset and they have a self-sabotaging belief that they can't go above that level. So you need to understand that when you're trading, it has nothing to do with your emotions or your mind, but just you following your trading rules and following your trading plans and see where it takes you to. Okay, it has nothing to do with your emotions. It has nothing to do with your thoughts. It has nothing to do with how you feel. The market does not care about you. So you just focus on sticking with your trading plan and understanding your risk before you take any trade. Okay. Then finally, you need to understand when you've crossed the point of self-confidence to a state of euphoria. Now, a state of euphoria in Forex is when you feel like you have the market in the palm of your hand and like you can control the market at will. You are not a dynamic trader. You should not have this feeling. Even dynamic traders who have the capacity of moving the market at will do not have this feeling. It is a bad feeling because it tends to kick out the aspect of risk. And most times the error that can be associated with euphoria has to do with position size. And so a normal trade, you would use probably a 0.20. But because you've gotten to a stage of euphoria, which usually happens after a series of wins, you feel that, oh, you've perfected the market, you know how the market moves. Then instead of you using 0.20, you go and use one lot size. And that's when the market is going to hit you hard. And is when things like this happen, people usually have trading paralysis when you're awake, you're present, you're looking at the market is moving against you and it's taking chunk out of your capital, but you can do nothing about it. You're just stuck and frozen in your trading seat. And eventually, usually it's to a margin call. All right. So try to identify when you're having these feelings and try to negate it. You can negate it by walking away from the trading system or consciously reducing your exposure level by half. So for example, if you're using 0.2, use 0.1 or 0.05 so that you don't, so that even if the market goes against you, you won't make so much losses. Okay. Here is the footnote. The footnote says the more you learn from the market, the harder it becomes to execute trades because of conflicting stress. So a lot of people go around. I see people every day going around looking for new trading system, a better trading system. And what they just tend to do is they keep packing garbage and junk in, which if they want to eventually make money in Forex, they have to unlearn those things. So a lot of people go, they try to learn Bollinger moving average, exponential moving average, Ichimoku, um, supply and resistance, Fibonacci, market structure, Elliott wave, harmonic patterns. And by the time they pack everything, and they try to trade, they won't be able to trade because one will be saying buy, one will be saying sell. And at the end of the day, most of the time, they go with what they feel is right and they don't make a detailed plan. Then they eventually make losses from the market. So try to simplify your trading analysis as simple and as detailed as possible. It can be comprehensive and simple at the same time, but it doesn't need to be scattered. It doesn't need to be everywhere. You don't have to use all the patterns. Just pick the patterns that you can identify and relate with and use it in your trading system. There are 3 stages of becoming a consistent trader, and I'll break them down below. First, we have the mechanical trading stage. This is the stage where you're trying to develop a habit of sticking to your plan. So your focus is, and if possible, you could print out the step and say, okay, I will do 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So that's what you'll be doing as you tend to build a habit of sticking with your trading plan. At this point, you may make some errors here and there, but you're conscious of those errors and you're correcting it at this point. Okay. Then subjective trading is when you're familiar with your trading plan and you're now comfortable. So you're flexible as when you're applying it because you understand your group loss. You understand that you need to manage your risk and manage how much you lose per series of trade and things like that. Then the intuitive trading is when you have your trading plan at the back of your hand and you understand it like you understand your name, like you know your name. So without consulting any book or consulting the trading plan, you look at the market, you know what you're looking for in the market, then you take your trade. You already know the expected lot size because you already know the risk and the associated lot size to the trade. So everything becomes perfect because at this point, there's no conflict between your trading plan and how you trade. So you and your trading plan are now in sync. This is what Mark Douglas in his book termed as a trader in the zone. Okay? See the footnote below. The holy grail of technical analysis is identifying repetitive pattern. In the market creates repetitive patterns. So you need to identify those patterns. Now, these patterns have to be profitable to you and they have to be profitable over a series of trade, not a trade by trade basis. So what does this mean to be profitable over a series of trade? If you're going to take a trade, if you're going to use a trading method, apply it on 20, minimum of 20, you could use 30 or 50 trades, apply it on it. So By the time you apply it, you'll be able to say, okay, over a series of 20 trades, this pattern has been repetitive and they've been profitable 60, 70, 80% of the time. And for every one loss I make 2 times the profit. So you don't know which of the trades would be losses. So your first 5 trades could be losses. You understand? But your next 15 trades could be profitable. So you don't do it on trade by trade basis. Rather, you do it on a series of trade. And once you do that, and you see that it is profitable for you and your win-loss ratio is high, you should apply it continuously till it becomes a habit. Once it becomes a habit, you have a holy grail in your hand, regardless of the trading analysis you're using. Once it gives you a high win ratio and it gives you a high risk reward ratio, and you can use it over a series of trades repetitively or continuously, then you have a holy grail in your hand. Step-by-step process of integrating consistency as part of your trading process. 1, you need to understand that you're a passive trader. You have no control over the market, and you need someone to buy or sell at a worse price than you to make money. I spoke about this earlier. If you buy gold at current price 1442, for you to make money means that someone has to buy at 1743, 1744, 1750. Someone has to buy at a worse price than you or sell at a worse price than you. It has nothing to do with you. You have control over your resources. That's the reason why sometimes they'll say not trading may be a way of making money. So you have control over your resources. So what the market does is up to the market. You don't have control over the market. So you shouldn't be concerned about what the market is doing or why the market is moving. However, you have control over your resources. You should be more concerned about what you're doing with your resources and what you're using your resources for. Okay? 2, do not focus on the outcome of the trade. Rather, focus on the outcome of the process. Be concerned on if you're sticking to your trading plan and executing it accordingly, or you're violating it, rather than whether the trade is profitable or not. Because in the long run, sticking to your plan and executing it perfectly will be more profitable than you checking whether this trade is profitable or not. If it's profitable, you may get to a stage of euphoria that you know what you're doing. And if it's making losses, you may get into a state of fear and you start making errors both ways. Okay? You can have a profitable bad trade, which means that you can go against your plan and still make money. But in the long run, it's going to work against you. And you could have a good trade that hits SL as long as you're sticking to your plan, which you planned initially before taking the trade. Whether it hits SL or it hits TP, it's a good trade. Okay? Plan your trade methods, stroke analysis diligently, and utilize the information you obtain from your trading method dedicatedly. Okay, I think that speaks for itself. Plan your trades. Apply the plan that you've done for your trades. Execute it. Don't deviate. Stick to your trading plan. If all traders could just stick with their trading plans, we would have more winning traders today. When utilizing your trading method, focus on the result of a series of trades, minimum of 20 sample size, and not trade by trade basis. I've spoken to this also earlier. Don't focus on the outcome of each trade. Rather, pick a sample size before you start. Say, okay, I'm going to use 20 trades or 30 trades. So place your trades, stop loss, TP. When the trade moves, at the end of the day, you know the outcome, whether you're being profitable or not. Okay? Number 5, be comfortable with the outcome of your overall SL stop loss on a series of trade and not trade by trade basis. So I would use an example to explain this. You have $1,000 and you want to risk 20% of the $1,000 to trade on a series of trade. Okay? So you have 20% and you want to take 20 trades. 20 divided by 20 means that per trade, you're meant to risk 1%. Okay? So 1% of $1,000 is $10. Okay? So if you're going to take a trade, your exposure, your stop loss per trade should not be more than $10. So if the 20 trades hit stop loss, the maximum you're going to lose is $200, which is the 20% you had already planned for. Okay. But if the market moves in your favor and the 20 trades move right, you can make $300, $400, $500. It doesn't really matter. But your risk must be predetermined on the series of trade. Not that you want to lose 20%, maximum of 20%. Then your first trade, you're exposing yourself to $50. If you expose yourself to $50 and you lose 4 trades, you've already lost 20%. So before you start trading, determine in your mind that you're going to lose maximum of, that you're going to trade for this series, 20 trades. Now, those 20 trades, identify how much exposure you want to take on those 20 trades. If you want to take 1%, you know that you're exposing 20% of your capital. If you want to take 2%, you know you're exposing 40% of your capital. If you take 3%, you know you're exposing 60% of your capital. So before you take, so no particular trade is going to throw you off balance because you've already planned for the loss of the whole set. Okay? When you're going to take your trading method, set the SL on all the trades. Say, okay, I want to lose 10% of my capital. My capital is $1,000. 10% of my capital is $100. And I want to take 20 trades. 20 trades divided by $100 means $5, which means that the maximum loss you're allowed to take per trade should not be more than $5. So you need to keep that in your mind when you're taking your trades, okay? After you're done trading a series of trade, as we discussed earlier, this series of trade that we're talking about is when they say a trader is trading in probabilities. So you have a sample size of 20, you don't know which one will be successful, which one would fail, but you're expecting that, okay, by the time you're done, maybe you get 12, you win 12, or you win 10, or you win 14, or you win 16, or you win 18 or 19, or you even win the whole 20. But you're trading a series of trade. By the time you're done with the series of trade, if the results are not favorable, let's say out of 20 trades, you lost 12 and you won 8, then you can tweak your trading method. Or after trading the 20 trades, you won 10, you lost 10, but your risk reward ratio was low in the sense that your risk was 2, your reward was 1, then you can tweak it. When you tweak it, then you start the process all over again. All right. Do not tweak your method during the series of trade. Let that series be complete. Remember, we don't review a trade, we review a series of trade, a sample size of trade, minimum of 20. Then you continue this process till utilizing your trading method has become a habit and there's no conflicting interest anymore. Now, I'm applying it in reality. In a week, you can have 20, 30 trades. You can decide that, okay, each week I'm going to take 20 trades. And per week, I think for a moderate exposure, you should not expose more than 10% of your capital. Now you can say, okay, for 10% of my capital, I'm going to trade 20 trades. And for those 20 trades, I'm not going to risk more than 0.5% of my capital. So all your stop losses should be 0.5% of your capital. Then you use that as your risk management and exposure strategy. Then you do your analysis. So when you do your analysis and you calculate the distance between your entry and your SL, you find out the lot size that would ensure that if your SL is hit from your entry, it will not take more than 0.5% of your capital. Then you use that to set your trades. So all you just need to do is set your trades, SL and TP, then you can walk away. Then when the trades are now active, you can now say, okay, If these trades have moved, let's say your stop loss is at 20 pips. If these trades have moved 30 pips, I'll lock my trade at entry. Then I will trail my profit. You understand? So you need to determine your trading method. Then once you determine your trading method, apply it over a sample size. Identify your exposure, which is the amount you may lose. Then design it or define it in such a way that you are comfortable with it. Then you apply the trade. After the 20 trades, you sit down, review the 20 trades. Which ones did you lose? Which ones did you win? Is the result or outcome okay? If the result is not okay, you tweak it. If the result is okay, you apply it again, and you keep applying it and applying it and applying it till it becomes a part and parcel of you. Okay? Now, see the footnote below. It is almost as remotely impossible to lose 20 times in a row as it is to win 20 times in a row. Even with a flip of coin, if you're going to buy or sell 20 pairs, it is almost impossible to lose 20 times than to win the same way it is almost impossible for you to win 20 times. Now, this does not mean that it does not happen, but the occurrence is very rare. So I'm going to finally discuss the regular pitfalls in Forex trading. And after this, I will be putting an end to the session. Okay? One, we have traders who do not define their risk in advance before taking a trade. Some traders just here buy or sell and they take the trade without considering stop loss. I, for one, do not take trades without knowing where the stop loss is, because the stop loss determines where my entry is. Last week, I was talking to a group of people and I explained to them that for me, in stop loss, entry, and take profit, the most important for me is my stop loss, because my stop loss will determine how much lot size I'm willing to risk at the point of entry. I'm usually not bothered about the profit, but I'm concerned about how much I may lose if the trade does not go in my favor. Okay, so if you're a trader and you don't define your risk in advance, please start doing so now. Two, there are traders who define their risk but do not accept their risk. Hence, their losses usually turn to bigger losses. So there are some traders who will do the analysis and say, okay, my stop loss will be at 50 pips. But when the market now drops to 40, 45 pips, they will remove their stop loss in fair. And before you know what is happening, from 40 pips, the market drops to 60 pips, then 80 pips, then they start praying that the market comes back to 50 pips so that they can take their original stop loss. Eventually, the market will usually move to like 100, 120, 150 pips before, out of pain of taking additional losses, they close those trades. So if you're going to define your risk, you need to accept that risk in advance before you take that trade. Don't set a trade and say you cannot take the loss. Okay? And that's the reason why I gave a proper explanation on what it means to trade in probabilities and how it applies to using your SL or accepting your SL. Traders who hesitate, usually because of past experience, so that okay, the last time I had a similar pattern and I took this trade and I made losses. And now understand, because of the way time is, there are no two times that are the same. What happened the last time may not happen this time. Last time you might have hit SL, but this time you may make profits because you don't know who were the people in the market the last time and who are the people in the market this time. So you need a trading mantra so that you try to remove all self-doubt from your mind. Now we have traders who also jump the gun and enter trades prematurely. These are the people who trade because they are scared of missing out of a trade. Now what happens is, if you're expecting the market to move to a particular point, then from your entry, the market from your entry to SL is 50 pips. But because you're scared that the market may not get to your point, you enter the market earlier. You may enter the market at maybe 80 or 100 pips from your SL, hence exposing yourself to more risk. And usually it's a bad habit. So try to avoid bad habits that will make you to lose more money. Plan your trade and execute your trades as planned. Plan your trade and execute your trades as planned. There are also traders who get out of winning trades too soon and exit trade prematurely. These are also traders who have the fear of losing out, fear of returning money back to the market, fear of the market has moved in profit, it may come back to hit my SL. Stick to your trading plan. Your trading plan should be able to cater for things like this. If you set a trade and the market moves 10 pips, most of the time, out of fear, you take the 10 pips only for the market to move 100, 200 pips in your favor. Then you start biting your fingers. Try to avoid that by defining your risk and accepting your risk. If the market moves 10 pips in your favor and your trading plan is not to lock it at entry when it moves 10 pips in your favor, leave the market to breathe. Give it space. Let it move. Okay? Then there are traders that also move their SL prematurely, which I was just explaining. There are some traders that once the market moves a bit, they lock it at their entry. And most of the time, if you check those traders, it's because they know that the lot size they use would give them more loss than they can accept. So let's try to avoid things like this by setting the right SL and using the right lot size. Okay, so we also need to allow the market to breathe. The market is bound to move. You don't know the market, you don't own the market. So you can't just say from 0.1001, I want the market to keep moving up. It should not even come down a bit. You are not the owner of the market, for crying out loud. So please use the right SL, use the right lot size, and let the market do its thing. You could have trading plans that would say, okay, when the market moves 50 pips and my stop loss is at 30 pips, I'll move my stop loss to 10 pips because the market has. Be logical about it. Don't act on impulse while the market is active. Plan what you're going to do before the market starts moving. There are some traders who are also in a state of euphoria and they feel invincible. When you are in this kind of state, it's usually best to walk away from the market, because if you remain in the market would most likely collect all the money you've made back and probably some of your capital, if not all of your capital. Don't get to a point where you think you own the market or you know the market and the market must or will. I have a friend and I keep correcting him. He would say, GU will sell from here. And I keep telling him, you can't say GU will sell. Your father is not the owner of GU. Your father is not the owner of Forex market. You don't know what the market is going to do. And most times he's usually wrong, which is what happens when you speak out of a state of, I know. You don't know. The only thing you know is the amount of capital you have, if you are going to buy or sell, and how much you're going to expose yourself to. The footnote here is probably one of the best footnotes I've come across. The biggest inappropriate behavior in Forex is not defining your risk before you take a trade. It is usually best to define your risk before you take a trade. Know how much you're willing to lose before you buy or sell a trade. Okay? And with that, we've come to the end of this presentation or this session. We'd like to thank you for taking your time out to listen to this session. And we also want to appreciate Behavioral Effects for powering it. My name is Lotto Rules on Telegram. If you have any questions, comments, or inquiries, you could always reach out to me and I'll be there to answer you. Till next time, thank you and goodbye.